MBS were in a bad way right from the start today. Rough start. UMBS were down 30 basis points right away, bright and early this morning, based off of the non-farm payrolls report that came in today and crushed the market. Non-farm payrolls came in as adding 517,000 jobs versus 185,000 forecast. It was a very high print at 260,000 last month, so the 517 is incredibly high. Unemployment came in at 3.4% versus 3.6% forecast, which is 3.5 previously. The numbers on that number just don't ever make any sense to me. How do we add that many jobs and it only changes that much? Earnings came in at 0.3 on a 0.3 forecast. It was 0.4 previously. We also got 71,000 in positive revisions for November and December. We don't have explanations yet or even the ability to comprehend the size of the beat in juxtaposition to this month's labor data that's been released so far. Almost seems like somebody messed up an Excel formula or something. We do know that bonds are selling off heavily all day in response to it. On a deeper dive into the report of the 894,000 job creations, 606,000 were part-time. Average hourly earnings were up 0.3% in January, which is 4.4% year over year. Average weekly earnings, which what really matters, is up 1.3% in January, which is up 4.7% year over year. Boy, just enough money for people to keep putting stuff on credit cards. Remember, ADP earlier this week came in at plus 106,000, so there's a big disconnect here between these two reports. ISM non-manufacturing index came in at 55.2 on a 50.4 forecast. So all of this data is adding up to maybe the Fed wasn't right this week and inflation isn't calming down, because the job market seems to be getting better if this is all true. Coming into the week, yields were near the top of a narrow range at 3.4 to 3.56 on the 10-year. With both ISM reports, the jobs report, policy announcements from the Fed, ECB, and BOE, it was a distinct possibility that we'd see the range broken by Thursday morning. That looked like it was a work in progress. Then in a cruel twist of fate, non-farm payrolls beat forecast by the widest margin. Year and a half, 90 minutes later, ISM crushed all forecasts as well. These events combined to push yields to the top of the range on the 10-year, leaving us to hurry up and wait for the next set of potential market movers, which is going to take some stuff. At the end of the day, we were down 39 basis points on the 5.5, and the 10-year was up 12 basis points, ending up 3.51. On the MBS, that puts us right around at 101.36, puts us back down in this very narrow range between that Fibonacci 38.2 retracement and a couple of converging indicators right around 101.23. 38. So we did test that 200-day moving average, which was a nice line. We hoped that it would help, and it did not. Looking at next week, we don't have a ton of stuff coming. We do have a 3-year note auction on Tuesday, nothing on Monday. We have a 10-year note auction on Wednesday, 30-year bond auction on Thursday, and then we do get the federal budget on Friday, which is almost assuredly going to show that there's going to be a whole bunch of debt issued. Over the weekend, if you have some time, check out our common sources and influences, especially www.WellThatMakesSense.com, because if you have to communicate with anybody in a positive manner, in a productive manner, you'll want to know about copywriting, and that's what we're talking about right now on WellThatMakesSense.com.